Hello and welcome. Today we have two consultants again from the Netherlands, Bas Rebel, Independent Treasury Consultant at BRFC. Welcome, Bas.
Thanks for having me again.
And Gerben Weister, who's the partner at Transfer Pricing at Ecticon. Also welcome.
Morning, thank you.
And Mike Foy from Mondelez, who is Director Global Treasury Operations. Welcome to you, Mike, as well.
Thanks, Jack. Nice to be here.
And we're going to be moving on in our discussion of tax and treasury onto the implications for corporate treasury technology in the new OECD regulations, which were published last year and have significant implications for treasury operations. Gerben, can you talk us through this explanation side of where we are on OECD guidance so that we can look at the implications for Treasury?
Yes, thank you. Yeah, so what we discussed in the prior web chat is that early 2020, the OECD issued guidance on the transfer pricing aspects of financial transactions. And that was essentially the first time that very detailed guidance was available for tax and transfer pricing people on the information and analysis the OECD expects you to apply in the transfer pricing analysis of financial transactions. And some of the most important elements there is that it's clear that the transfer pricing requirements are more than just pricing alone. You need to consider whether the elements, the terms, conditions you're agreeing are similar to what independent parties would have agreed to. Is this something you would do in practice? So it's not just the pricing that needs to be arm's length, but your terms and conditions must be arm's length as well. So if you need funds for 1 year, why would you give a 10-year loan? One of the impacts is also that certain loan features, such as subordination or bullet repayment, may require a bit more support than you would have provided to it in the past. And an added element with increasing transfer pricing documentation requirements, it's also clear that you need to reflect in your transfer pricing documentation that you're actually applying this guidance in your policies and practices. And as a result, ongoing documentation is required for which ongoing information is needed.
Bas, is there, from your side, any implications here that we need to talk about before we move on to two particular examples?
My takeaway from last week's conversation is there is no time to lose. The guidance are already referenced by tax inspectors around the globe. It is very difficult to retrofit any of the information that they may question about. So you need to be prepared that there is more information, even on past transactions, that is required. Now, in my experience, a lot of the intercompany loan documentation is not necessarily readily available whenever it's questioned by outside parties. So in order to save time, be prepared. Now, going forward, of course, you should adopt as quickly as possible so that you don't have to reconstruct the evidence that the tax inspectors are looking for.
And that's the framework of where you've taken two examples of what really needs to be focused on. The first one is on in-house banking, as you call it, the next generation 2.0. Bas, can you explain this? Because this is fundamental here.
I was referring to the next generation of in-house banking primarily because I believe that, in my experience at least, that we are quite familiar nowadays with payment factory and in-house banking as the intercompany current account, but that's primarily for a consolidated and centralized liquidity management. Now, with these tax OECD guidelines in place and the quest for more detailed information, we need to zoom in on the liquidity per individual subsidiary more closely than ever before. And if we combine the administration of the intercompany current account with a more detailed administration of intercompany loans, I think we have a key building block for the reporting and the information requirements that tax inspectors may look for in the local and the global file, but also in their queries afterwards. And the third element that we have to add to the payment factory and what we currently know as the in-house bank is to formalize the intercompany capitalization process. And we need to have a better intercompany loan management, but we also need to implement processes around credit acceptance and credit monitoring.
Mike, is this new, this intercompany capitalization? Surely you're doing it already.
Well, in some respects, I think that you would look at the longer term financing of an entity, and where it makes more sense to have some kind of capital injection as opposed to intercompany lending, you would make those decisions. Capitalizing entities isn't something that people would just do lightly, actually, because that's quite a kind of life-changing business aspect of the market. You would look to capitalization as probably a last resort. But here what's happening is that, maybe this is focusing the thought where people, I'm not saying from our Treasury, but just generically, you could have lending regimes that you put in the past feel appropriate because they're flexible and they work, but actually not really addressing the problems. So it may well be that it leads to a future kind of capitalization or a longer term structuring of debt, which is of a short term nature. So, the rationale behind where you first maybe implemented some financing transactions to the market could be changed not just by your own internal scrutiny about the appropriateness, but now having to explain that externally.
And Gerben, your take on this?
Well, I think from a tax and transfer pricing perspective, what is important for us, and the thing we often ask first, is whether there is a simplified summary of all those Treasury practices and the day-to-day operations. Because essentially what's important for us is that we need to be able to explain it relatively simple and short, what is happening in these elements for the various countries. And the thing you see here is, of course, the day-to-day practice of an entire the department, where we want to summarize it in a few pages in the documentation. That's sometimes a struggle because it's not necessarily easy and it's a lot.
My takeaway from this is that the new element in here is the tracking of the loans, not just in the initial setup, but moving forward. And that actually leads us to the next slide where we're talking about the Treasury technology. Bas, explain what you mean here by this slide.
Yeah, I think the foundations of this slide is quite familiar to many a treasurer that has a treasury management system. We have the treasury management application in the middle, and the banks on the one hand, and the intercompany systems on the right hand. But what I mean here is that you can leverage this whole technology stack for more detailed reporting, not only for management reporting and compliance monitoring, but now also for tax reporting. At some point in time, your tax colleagues will need to fill the local and the global tax file, and they need all kinds of information about the loans outstanding, etc. And then for the tax audit afterwards, they may come and say, hey, when did you decide and why did you decide to give a specific loan, and why did you decide on a specific structure? And in more detail, when we are combining the intercompany current account administration with the intercompany loan doc administration, you get an up-to-date insight in what the liquidity position of an entity is. Now, mind you, liquidity on the intercompany current account for tax purposes is not the same as liquidity on an external bank account. And we talked about last time when we talked about the cash pooling, we were talking about avoiding the building of structural balances in the intercompany current account. That implies that you need to have the reporting at entity level to substantiate the structural balances. And just to give you one example, I was partially involved in a tax audit where at the start of the year, the company had a large balance. And at the end of the year, there was a large balance. And the tax authority basically said, you have a structural cash balance. Now, in fact, there was a seasonality in there. And so they had to prove that the intercompany current account, basically the cash pooling, had a seasonality pattern in there. And they only could reconstruct that evidence by going back into their accounting system and retrofit all kinds of things to show the graph that this was really a seasonality pattern and there was no structural balance in there. Now, you don't want to do that after the fact with all the response time, short response times on questions. So building the reporting stack on top of the treasury management application is going to be a task that you that you pick up rather sooner than later. And in that data lake or reporting stack, you have to combine the information that you store or may need to elaborate in the Treasury management application, but combine that with all kinds of balance sheet information that you maintain in your ERP or your consolidation software. So you have the tax reporting for the tax auditors, but you also can manage your key balances and ratios actively and upfront. And furthermore, this kind of information is also needed whenever you have to issue new intercompany loans, because you have to substantiate your credit decision with the information from the moment that you make that decision and issue the loan. And that is information that you then have to combine in your loan documentation so that you can pull it off, let's say 5 or 10 years from now, if and when the tax authorities are asking for it.
Mike, this sounds like a new level of documentation. Can your systems, both your TMS and your ERP or other systems, cope with this? Do you need new systems?
I think the simple answer is no, they can't. Not as present, and not perhaps in the way in which we'd want them to be. Baz points to the fact that it's true that there's a lot of information sources that have gone into either the inception of that loan, quantitative and qualitative information, as well as the fact that there are certain financials and rigor that you need to look at, which, they can manifest themselves from all sorts of areas, not necessarily off the ERP, but also you may be putting a loan in for project management purposes or things like that. That's future cash flow. So measures you can't necessarily relate to. And that's at the start. That's a substantiation we've all been talking to, and the appropriateness of the loan, and the rationale behind why you got to the decision that you made at that point in time. That's just that point. That's a nightmare enough. But then how are you performing going forward against all of that? So you're sourcing information, as Baz says, from your treasury management system. That's fine. It's a matter of record. But then also about the softer focus things, about how is that now complying against perhaps the purposes and the expectation you had at the outset. There may be queries and questions on that because your rationale said you were doing it for a purpose, and your actuality may be pointing to something different. And that may not even just be the up and down or structural nature of a pooling balance, but just how the repayment schedules have worked to another. So it's vitally important to be able to coordinate all the information sources that you have. I don't actually see that you could do it all in one area. But as soon as someone captures something, which could be a big umbrella for transfer pricing, documentation management, quantitative and qualitative assessments, and rigor and re-scrutiny, then so much for the better. It's a very difficult thing to have to try and pull all these salient pieces of information together and have that in such a way as it's quite easily shareable between you and your tax colleagues, because the points are being made by Gerben and Baz that actually there's a lot of complexity in what we're talking about in Treasury to arrive at where we've got to and how we analyse where we're going. But that can be explained in quite simple terms on a one-on-one basis with a tax auditor who's looking at this without inside company knowledge. And the intermediary within all those things, from a Treasury perspective, is going to be your transfer pricing team or consultants. So you need to be able to have this data ready and available in a way it's readily explainable, it's usable, shareable, and will stand up to scrutiny. That's a whole load of moving parts which are very, very difficult to manage. So
do you need to build a new system?
We make you do at the moment, to be honest. If you can consider, the ERP is providing certain pieces of information. We can get a snapshot. ERP, Treasury Management System, it's SAP for us all the same. But that's just giving us one piece of information. Another is the backdrop of what we've got, and another would be maybe the financials that we based a decision upon. The thing we're using at the minute to bring those together in lieu of there being anything better is really just putting it in OneNote and having different tabs for different areas of all of that and an overall summary. So you've got a book of the loan. You've got a book of the loan, and then you've got pages for ongoing assessments that you can call out. And then the transfer pricing guys can take one of those pages, share it with the authorities if they need to, and you preserve what's left in your areas. But that's not really a systematic approach. That's just really using software and work tools really for images. It's not consolidating information, and it's not in any way dynamic.
I feel a nightmare coming on. Gerben, what's your take on this? Because the transformation of the level of activity and reporting and tracking is huge.
Yeah, I think that Mike just made a very important point from a tax and transfer pricing perspective, that we really need support from the Treasury people to help us interpret and summarize all this information. Because as you can see, there's a huge amount of information available, but that doesn't necessarily mean that tax or transfer pricing people or tax inspector are able to appropriately interpret what the reports mean. So I think the first step is that tax and treasury really need to talk together to understand what it is for the treasury people, what the transfer pricing people are looking for, and for the transfer pricing people to understand, well, what is the information available? Because I think sometimes there's also requests for data that may not be tracked. So then you have to think about, do we need to build an extra reporting cycle, or was this a once-off question and there's no use in doing this every month because we may not need it? But there's also other elements that we often ask about the descriptive information about it. So what was the purpose of the loan? Well, in the financial administration, the purpose is not always there. So there's also other information we might be looking for that's not yet in the system, which doesn't mean the Treasury people don't know it or haven't considered it. It's just a question, well, where do we track and trace it and how do we find it back? So I think it's especially this interaction that makes it, from our end, of course, interesting, because it's interesting to see, but it makes life immensely difficult for Treasury, because they have yet another stakeholder that's interested in everything they do day to day. And can you please put some reporting in place? That's the simple summary question.
Mike, are you getting any support for, you said you just got temporary solutions, and it's support for a longer term, more cohesive and comprehensive solution?
At present, I think we're working through on this because, although the regulations were in from about February and discussions have been throughout the year on it, it's still very formative about what is actually the right thing to be doing here. So we think that where we're going with the kind of one note approach and keeping our documentation where it stands at the minute is working okay. And if that then says, well, this is the output that we really need it to be, this is how we want to use it, this is the flexibility of it, then we'll look at something longer term, more robust to do that. At present, like I say, I can't actually see where there's a panacea for all of this. It's just nothing out there that really is ringing the bell. And with Treasury priorities at the moment, I'm not sure it stands on everybody's list. This is high on ours, but not the highest. There are a series of other things that will be taking precedence on this and systems aspects that we need to move over. So this one is going to have to, move and evolve in the way in which we can do it in a pliable way, without rigging it in, wiring it up to a systemized approach, and then looking at what the best course of action is going to be after that once we've established it works for all the parties in the organisation.
Yeah, liquidity management is a bit more important than this at the moment. But in 5 years' time, you could be facing horrendous levels of problems.
I'd agree. Yeah.
Okay.
If I may chip in here.
Yes, please.
I believe that many treasury management application has much more functionality than is currently used by the individual companies. Think about a loan documentation. I'm not sure that everybody is using, for instance, the built-in functionality to store the documentation with the loan in the system itself. And you can, and many a system does have that kind of information. I also am not sure if many a company has implemented the intercompany current account, the classic form of in-house banking and treasury management application, in a way that is really an active intercompany current account where you can track what the liquidity is that they have deposited with Treasury, so that you can run reports like or graphs like the one on this slide. And based on this graph that you see here, you can detect that there is a structural balance growing in this intercompany current account. I'm not sure that everybody is aware of that kind of information. So it's also about leveraging the functionality you currently already have at your disposal.
Yeah, it's the Excel story all over again. There's so much functionality that you've never used or didn't even know existed, which could be useful. But there is definitely going to be some move to use this much more. If we bring all this together, what would be your key takeaway here, Mike? What's your key takeaway from this?
Yeah, we need to provide lots of documentation and substantiation to external parties. So, the audience that we have for our treasury activities nowadays is a lot wider. It's external as well as internal on transfer pricing resources. And it's a difficult series of different pieces of data inputs that we need to bring together and have them in a concerted manner that's easily shareable and, like I say, stands up to the scrutiny and the requirements of these new regulations.
And Bas, what would be your takeaway?
My takeaway is there is no time to lose. As we have said, the OECD guidelines are already taken as a guidance for current audits. So expect that will grow in the coming years. It's not 5 years from now. So get your house in order so that you don't have to scramble for the evidence or reconstruct the evidence if and when tax authorities comes along. The other takeaway that I see here is that tax and treasury will grow together. They will have to coordinate and collaborate much closer together in the coming years than ever before.
Gerben, what would be your takeaway here?
To be mindful to take first steps first. So I think I would also take this as an opportunity to look at some of the policies, because a lot of the tax and transfer pricing questions will be around, can you explain why you do what you do? Why do we use a current account in this instance and a long-term loan in that instance? So I think the story about why the structure is what it is, which is entirely known to everyone at Treasury, may not be completely documented for an outside party. So I think that's where I would start, with understanding why it is we use the instruments we use. And from that comes all the documentation that we would sort of expect to be there following those initial steps.
Thank you. And my takeaway would be, first, record whatever deal you're doing on intercompany loans and other transfer pricing, and then track it. And finally, check out the functionality of your TMS. You're probably going to be pleasantly surprised. So thank you, guys.